Hey, what's up guys? Welcome to Smart Wallet and Me, where financial wisdom really matters. Today I'm going to do a video discussing two different people, one investing in their 20s and another one investing in their mid 30s all the way through 60. And let's see who comes out ahead if they pay the same amount of money in their investing account. For the first person pays the same amount for 11 years and the second person invests the same amount but for the entire 26 years of their career. And let's see who's going to come ahead. I'm sure you already know the answer, but I'm going to do some different scenarios and you might be surprised about something. Okay, but before I do that, I want to do a history a little bit about the stock market and give you guys a little bit of a brief background. So the average stock return can be measured over a number of different time periods and by looking at several market benchmarks such as the S&P 500 index and the Dow Jones Industrial Average. The S&P 500 and the Dow are two of the most quoted and influential stock market benchmarks and are often used as a synonym for just the market. The Dow Jones Industrial Average's inception date was May 26, 1896. Through May 25, 2018, the index's average annual return has been 5.42%. Through the end of 2019, the Dow Jones annual rate of return since inception has been 7.75%. This has varied over time, of course, and for the 25-year period ending January 6, 2012, the index had an average annual return of 7.55%. And for the 91 years prior to 1987, the average annual return was about 4.3%. Now, on the S&P 500 side, the S&P 500 index began in 1926 and was known as the composite index. The index was originally composed of 90 stocks, and in 1957, the index adopted its current format of including 500 stocks. The average annual returns for the index from 1957 through the end of 2018 were about 7.96% or 8%. The average annual return from its inception in 1926 through the end of 2019 was about 10%. It's very important to note that past performance doesn't guarantee future results. But if you want to take a more aggressive approach, you can invest in a growth ETF like VGT and you can average an annual rate of return of about 22.3% over a 10-year period. However, just remember that with a greater rate of return comes higher risk. So take that into consideration. However, if we take a conservative approach and say that the next 20 years would yield an annual rate of return of, let's say, 8%, we would come up with these numbers that I'm going to show you right now. If you make a monthly contribution of $400 or an annual amount of $4,800 starting from age 25, you will come up with $5,184 in the first year, $10,399 in the second year, so forth and so on, until you come up to the very end over here. After 60 years, you would have invested $52,800, but your final retirement value would have been $552,859. And remember, you're only investing for 11 years, putting in $4,800 every year for 11 years, and you've invested $52,800, you come up with $552,859. Conversely, if you invest $400 every single month or $4,800 every single year from age 35, now that's only a 10-year period, guys. I'm specifically talking to young folks right here, for the millennials, for just the young 20-year-old average guy who has a job, who can afford to put $400 aside every single month. I'm talking to you specifically. If you see this, you should be amazed by these numbers, because just 10 years from 25 to 35 and investing the same amount, but this time you're investing 26 years from age 35 to 60, you would have invested $124,800. But look at this, your final retirement value would only be $386,411. Now when I say only, that's still a lot of money. I'm not making fun of that number because that's still a good amount of money. However, when you procrastinate, and I just did a video on that yesterday, I want you guys to go look at that. If you procrastinate just by 10 years, you would have lost 43% of your final retirement value. And not only that, but you would have invested $72,000 more than you would have had if you had started at age 25 and stopped after 11 years of investing. Guys, this is amazing. I mean, look at these numbers. They speak for themselves. If you invest this money at age 25, you would have $552,000. If you start at age 35 with the same amount but going for 26 years, you would come up with less. So the sooner you begin investing, again, there's never a time that is too late. It's always better to start now. Even if you're 35 or even if you're 45, it doesn't matter. As long as you start investing, the power of compound interest will work for you. The sooner you begin, the sooner you retire, and the more wealth you will have. It's simple as that. You let your money work for you, and you let that compounding interest work for you. And you can play with these numbers. Let's say if you want to invest $700 every single month, which comes out to $8,400 a year. At age 25, look at that. You will come up with almost $1 million, $967,504. And if you started that at age 35, paying the same amount of money from age 35 to 60, you would come up with $676,219. Again, you would have invested $126,000 more starting at age 35 than you did at age 25. And again, guys, this is something that really should motivate you, not to put you down, not to discourage you if you're older. I'm trying to motivate the young guys so they can get their sense together and start investing right now. Don't wait longer. If you wait longer, you're going to lose more money, or the potential of making more money. I should put it that way. You will lose the potential of making more money. As you can see here, if you invest, you're still going to make more money. You're still going to come up with $676,000. But what would you rather have? $676,000 or $967,000? You make that decision. You put the amount that you want to come up with. Whatever amount you want. You want to put $300 a month for $3,600 a year? These are the numbers that you're going to get. And guys, I'm going to do everything I can to try to get this spreadsheet into my description. I'm still trying to figure out a way of doing that, but I will find a way of doing this. I created this Excel spreadsheet. You can find it also online some places. But guys, this is my spreadsheet that I created that I want to share with you to help you guys so that you can put in any number you want. And if you want to put, let's say 20% rate of return, if you're going to be more aggressive, and look at this, you're going to come up with $11 million if you just put $300 every single month into this account versus $2 million. That's a 443% difference, guys. That's huge. That's a strong growth ETF fund right now, like a VGT. Again, past performance doesn't guarantee future returns. However, looking at the long term, if you're in this in the long term, then you can easily make a lot of money in this by just investing early on. If you take a more conservative approach and say, okay, I'm going to get 10%, look at that, $732,000 versus $396,000. All right, guys, I hope this motivates you. I hope this will make you to go invest early on. And I hope that you guys found this information useful and that you would use this information. And please don't forget to smash that like button up. And I'll see you guys in the next video. Thanks for watching.